So here we are, Mullen Automotive is officially no more, and in its place, we now have Bollinger Innovations, trading under the ticker BINI. But let's not kid ourselves. This isn't a rebirth. It's a cosmetic maneuver, a rebrand born not from innovation or growth, but from desperation. On Monday, July 28th, the name change and ticker switch went live. The company claimed in a press release, not an NSEC filing, but just a press release, that the transformation was complete, and that Bollinger now encapsulates its commercial Class 1, 3, and 4 electric vehicles under one unified brand. The market didn't buy it. Shares fell over 2% on the day. And it got worse. On Tuesday, July 30th, the stock cratered another 11% during normal trading hours. That's nearly 14% lost in just 2 days under the new BINI ticker. And remember, this is a stock that has already been ravaged by years of dilution, reverse stock splits, and broken promises. So what exactly is happening here? Let's go back a step. On June 2nd, Mullen carried out a massive 1-for-100 reverse stock split. The goal? To push the share price above $1 to regain Nasdaq compliance. It was approved during a May 21 special meeting, and at the time, it slashed the share count down to roughly 800,000 shares. Then, just weeks later, the company filed another Form 14A on July 8, proposing yet another reverse split, this time ranging from 142 up to 14250. That meeting was supposedly held on July 26, and was likely their last shot at using a reverse split to stave off a Nasdaq market cap-based delisting, which has a hard deadline of August 26. But here's the thing, since that July 8 filing? Nothing. No 8K. No SEC update. No confirmation of vote results. Instead, Mullen, now Bollinger Innovations, put out a press release claiming they had eliminated all outstanding warrants and $25.3 million of convertible notes. Supposedly, this move boosts shareholder equity by $133 million. Sounds great on paper. But where's the documentation? There is no SEC filing confirming the structure of this deal. No Form 8K. No amendment. No share issuance breakdown. No disclosure about how many preferred shares were created, or what dilution might result. Just a corporate-sounding press release and a new name. Let's be clear, if the company has in fact cancelled $25 million in debt, that probably came at a price. Most likely, the debt was converted into preferred shares or new common shares issued directly to insiders or institutions. That increases the outstanding share count, which is crucial, because market cap equals share price times outstanding shares. Right now, BINI trades at around 6 or 7 cents per share, and some sources have pegged the market cap at below $1 million. That's dangerously below the $35 million Nasdaq minimum for listing. So what's happening here looks like a strategic, and arguably desperate, move to clear out the dilution overhang by removing debt and warrants. Increase the outstanding share count quietly, likely through preferred equity. Artificially inflate the market cap to buy more time before the Nasdaq deadline. It's smoke and mirrors, a PR stunt dressed up as corporate progress. And it's not the first time this playbook has been used. Let's not forget, Mullen has executed multiple reverse splits over the past 18 months. Each one promised a reset. Each one was framed as a turning point. And each one was followed by more dilution, more filings, and more value destruction. The company's website, now operating under BollingerEV.com, offers little transparency. Previous press releases and financials from the Mullen days have been removed. There's no record of insider activity, no current investor relations documents, and no new filings under the BINI ticker on the SEC's EDGAR system. So here's what we're left with. A new name. A new ticker. A stock that's fallen nearly 14% in 2 trading days. And no meaningful disclosure to back any of the claimed financial improvements. If anything, this looks like Mullen's final roll of the dice. A last-minute brand swap, a loosely detailed debt shuffle, and a thinly veiled attempt to stay above water until August 26, when the Nasdaq delisting deadline hits. And here's the brutal truth. If that deadline comes and there's still under $35 million in market cap, BINI could be delisted from the Nasdaq entirely, relegated to the OTC markets, if it survives at all. That would crush what little liquidity remains and potentially make the stock untradeable on most retail platforms. So what should investors do? Be skeptical. Be vigilant. And most importantly, demand real transparency. Because until we see verified filings, not just press releases, this rebrand is just a smokescreen over fire that's still burning. Same leadership. Same tactics. Same result. The name might be different, but it's still Mullen behind the curtain.